Hello everyone and welcome to another wonderful video with me, Honest Regards I'm Tejiri. Just in case you're coming to my channel for the very first time, do well to hit the subscribe button and let's get the video started. So right now, yesterday we had to finish up module 1 right now in forex trading, which is introduction to forex trading. What is forex trading? We did that definition and the basic of forex trading, history and significance of forex trade, the forex market, and the key players in the forex market. We touched all about that yesterday. All about that. Okay, yeah. And today we are going into the part 2 of this module 1, which is, you can see it right here. Let me make that big so we can all see that. Let me take it back to the first place. Now, for you can see how forex works is today gig. How forex works. Let me highlight that so we know what I'm talking of. How forex work, currency pairs and quotes, basis and quote currency. So basically, you're going to be saying this. I'm going to be putting the write up on the screen. I don't know why I'm saying that, but I just had to say it. So now I'm going to go straight into the video. Now, basically, this was you're going to be using more of trading view. So get familiar with it, seeing it on my screen. So right here, let me share. Okay, and okay, now we're back. So now let's continue with the module for today, which is the part 2 for the module 1. Remember, this module 1, introduction to forex trading, knowing about forex trading. Now for how forex trading works. Now first thing we're going to talk about is currency pairs and quotes. That's basically what we're going to start with. But first thing is currency pairs. We should know what currency pair. We talked about that yesterday. Yeah, Euro USD. Euro is the base, and SAU, which is the quote currency itself. So now let's get it going with today's module. Now for forex trading, first thing is currency pairs and quotes. Now we know forex trading involves exchanging one currency to another, and also currencies are always quoted in pairs because a trader is buying one currency while selling the other simultaneously. Meaning when you click the buy or sell button, you can see right here on my screen. You can see it right here where it says you are seeing a sell and a buy button. Whenever you click that button and you're buying, you are simultaneously selling the other one. Even if you don't know you are selling it, so know that whenever you buy, you are selling the other, and whenever you sell the other, you are buying the other. That's not going to be a complicated something for you to understand. Now, understanding currency pair is going to be very important for you because you need to understand what's the base currency and the quote currency. Now, the first currency pair right in front of any currency like XAU USD. So this basically SAU USD chart. If you can see that on my screen. Now, the very first currency pair is called the base currency, and the other is called the quote. The first currency in the pair is the currency being bought or sold at your price. I don't know what's going to be your price at the moment when you're selling or buying. While the quote currency is the second currency in the pair, and it is represented as in a value of a currency and a value, a specific value for you. Now, I may put an example on the screen where I'll be showing you the example. I put an example on the last video, but I'll put that same example here, like USD. 1 euro equal to USD of 1.10 at my time, something like that. Now, which means 1 euro is equivalent to that amount. Now, if you believe euro is strengthening at the moment, you will buy euro, and if you believe this SAU is strengthening at the moment, you will sell euro by clicking sell button, and it's going to work in simultaneously. What I just want you to understand is that currency pair is going to play a very big and a very crucial role in your trading experience because you're basically going to be using them. Either you're trading the forex market, the stock market, indices market, any of their volatility indices. The strategy I'm going to be teaching right over in the video are going to be very important for you, and if you follow them, you're going to make a lot of money from this industry. Can I say that? Yes, if you follow the rules, because sometimes they tend to be very difficult to follow. And I can tell you that having the rules is one thing, following the rule is another thing. I tell you from experience. Now, types of currency pairs, we know there are major currency pairs, there are minor, and there are exotic pairs. So now, what are the major pairs? Major pairs are the most traded currency globally, always paired with US dollar. Most of the currencies traded out there that are paired with the US dollar, they are mostly majors. Mostly examples, you have the euro, the GBP, the JPY, AUD, or that which is euro in case you don't know, European countries, GBP, which is pounds. You have US dollar, JPY, which is Japanese yen. You have AUD, Australian dollar. Those are major. Now, characteristics of this exact pair is that they have high liquidity and tight spread. Most brokers give very tight spread for them and low volatility compared to other pairs. They have low volatility, they have high liquidity, and they have tight spread. You can check on those quotes. Now, the second is minor pairs. These minor pairs, now, one thing you should know about them is that they do not involve USD. They don't have USD attached to them, but include stronger currencies like Euro, GBP, or JPY. You tend to see them more often and other stuffs. Now, example are like the Euro, JPY, GBP, JPY, AUD, USD. You can see that Euro USD is not being a base, and at the same time, Euro USD is not being a quote currency because sorry, USD is not being a base, neither is it being a quote. To tell you that it is not a major pair but a minor pair. Now the last are exotic, and these exotic pairs they involve one major currency with um paired with a currency from a developing or a smaller country. That's a country not so known or not so traded. And one of them is like you see USD TROY, which is Turkey, I guess Turkish lira. Yes, you have Sweden dollar, Sweden koran. So, yes, those are very minor kind of traded pairs. Mostly they are not traded. Most of them are not really not traded. Now, Currencies, they have low liquidity, no liquidity in that market. They have high volatility and wider spread because the major currency has so much value that it gives it a big and a spread that is you're gonna be like and you will not even want to trade most of these pairs. Now, the next thing we're gonna go into, because I have to check in my motion and make sure I'm following the slides, is yeah, we talked about currency pairs and quotes, base and quote currency, major, minor, and exotic pairs. Now the next is the concept of leverage and margin. That's going to be very straightforward and fast for us to know note into. Is that forex to note into. Now we know that forex trading is accessible to retail traders due to leverage because your account size of $10 can basically not really trade the market, but the market offers you what they call leverage. Now, leverage can be in 1:1. Take for example 1:1, meaning if you put $10, your trade will be based on $10, and that is going to be like nothing on the market. You cannot even open a lot position with that account size. But when the market tends to give you leverage, it helps you open trade that your account size originally cannot open. Take for instance $10 and you have a ratio of 1:100, which is anything you're having is times 100. Anything you're having is times 100. Now let me bring it in a concept where it says forex trading is able to retail trader like me and you, allowing them to control larger positions with small initial investment. You're having small initial investment, but you're able to control a large amount size and other stuff like that. So I'm believing you're basically seeing how the market moves. So get familiar with this. You're going to sit right here on the chart most times and you're watching this pan out. So now, leverage is the ratio of a trader's funds to the size of their position they can control. There's some position you can also control, and they give your account what they call margin call, which is your account's not able to hold the losses that will be run on that account. You want to be very mindful of the leverage. Leverage is very important, so be mindful of the leveraging you take in as a retail trader. Example, if a broker offers you a leverage of 1:100, that means that you can control 100,000. You can control $100,000 with having only $1,000. You can control $10,000 with having just $100. That's what the leverage is basically telling you. Now, advantage of leverage, well, there are advantages and there are definitely going to be risks involved with leverage. Now, advantages, it amplifies your potential profits. Yes, it amplifies how much profit you make from a particular trade. Now, you should know what amplifies me, and it enables trader to participate in markets with limited capital. You can participate in market. Let's say you are really good at the analysis and you want to participate in this market. Because of leverage, you are able to participate in it even with not having the good size of account to be able to enter that position. You can do that with leveraging. Now, risk of leverage is that it magnifies potential loss. It zooms into your potential loss, like the loss you are making zooms in, which can exceed your initial investment. Which can exceed the initial investment. The next one is it requires careful risk management. It requires careful risk management. Now, the next thing you want to talk about is margin. I believe that's on my notes for this module, which is margin. Yeah. Okay. Yes. Leverage. I talked about leverage. Now we're talking about margin. Now we say margin is the amount of money required in your trade account to open or maintain a leveraged position. You already understand what leverage means. Now, example, if you want to trade a position worth over $1,000 with 1:100, the required margin is 1% of the position size, which is $100. I don't know how I could break this concept down so you understand exactly what I'm saying. Leveraging is the market giving your account a larger amount than its initial amount, but it's not going to reflect on your balance that you're having a larger account. It's just going to be the ability for you to enter into a position. While margin is the amount of money that you use in entering a trade, the amount of money that is required to enter a trade due to your leverage. Meaning, if you have $100 account, you are going to enter a position of $10,000. Now, note this, that you are entering with $100, which is 1% of the account size. So now, margin call, we should know what's margin call. If the market moves against you and your account balance falls below the required margin that your account should fall under, let's say for example you have $10 and you're having a negative loss of $6, that's over margin of your account. That's over half of your account. Margin is going to call you. That's when you hear people say margin call out, margin call out, margin call out. They're telling you that the account has run into a negative that the account can no longer hold. That's what is required to as margin call. And if that happens, it can lead to a blown account. And most of us will know what's a blown account. Now, example, trading with leverage and margin scenario, trade something like USD. You have your investments. Now, I'm going to put this example right on the screen, which is trading with, you can see right there, trading with leverage and margin scenario of trading your USD. Now, you believe that your USD will rise, and the position you open is of $10,000 with a leverage of 1 to 100. Now, your invested margin is going to be one. Now, this way you calculate your investment is 10,000 divided by 100, which is equal to what? $100. Now, your outcome, if your USD moves from 1:1.1000 to 1.1100, which is 100 pips was added. We're going to talk about pips in the next coming lectures. Let me check that on my notes if we have pips here. Let me check that on my notes if we have pips right here. Yes, we have them, but that's going to be in module 2 where we're going to be talking about pips. So that's going to be in module 2. That's what we'll talk about pips. Yes, so this will be module 3 and we're in module 2 right now. So you understand more of this concept when we get into it. Now, one thing about it is that let's see how many more minutes I've spent on this video, just 11 minutes. Now is that you know that if your video goes in, if after watching the video and I'm teaching over and over again, I'm doing the greater good for myself and learning more. So you want to make sure you're following the video and you're catching exactly what you want from this exact video, because it's going to be a wonderful time just with you, because it's going to always be a wonderful time with you guys. Now, key takeaway for this lesson is that your currency pairs always involve a base and a code currency. Understanding the types of pair is crucial for strategy. You need to understand what kind of pair are you trading. I trade measures. Basically, I trade measures. Now, also, most time, the only pair I basically trade most times is the XAU USD. That's the only pair you will see on my watch list. Or let me go out of the full screen and let me show you the pairs I trade right here. If you look right here on my screen, let me make it bold so most people can see that I basically don't make it bold. I have a good eyesight. So I'm going to make it bold so you can see that you're having XAU and NAS. Those are the only pairs I trade. So you can see XAU, but this is meta. This is meta. This is not measure. This is meta pair. So this is one I trade. I'm going to make it smaller. I don't like this view for myself. I put it on 80% because that's where I like it. And you can see that currency pairs plays a very crucial role. Now, for the next thing you're going to note is leverage, a powerful tool that you can amplify your profit but can also magnify losses. And always use it with caution. I want to advise you use leveraging with caution. Now, your margin, essential for opening trades. Proper margin management prevents liquidation or margin call. Liquidation, there was a certain time I was saying liquidate me. I don't know that liquidation actually means the market giving you margin call. Liquidation is when the market sweep out traders. If you watch ICT concepts with ICT trader, most of these things I'm going to be teaching right here, they're from ICT himself. And he said, don't call me this, just learn with my strategy and make money off it. So you basically want to follow ICT himself. You want to follow ICT himself. He's basically he has played a very big role in my life. I've watched other Forex video and they flash up things for you, but it doesn't do the flashing. It just gives you the skills and the knowledge, and that's what I call a teacher. So you want to watch ICT concept, you can search for him, and also do it to subscribe to my channel. And now the last thing we're going to do is that you want to know margin call, your leveraging, and your caution. That's it for this lesson, guys. So I'll be dropping a learning activities for us to be able to get in touch with it. So till I come your way again, guys, I still remain honest to God's time. So peace out, and I'll see you in my next video, guys.